All right, so far, so good. Stocks posting strong gains this year, battling through inflation and a series of rate hikes. But if the Fed keeps hiking rates, particularly at this next meeting in a couple of weeks, could that actually trip up the stock market? Let's get a read now from our money panel. Melissa Armo's with us, and David Stryzewski is with us as well. Melissa, let me start with you. First half, phenomenal. August down a little bit, not a lot, but how are we positioned? Let's start macro with just the general economy. Where are we right now?
Well, remember, the economy seems like it's great, but this is really a bounce back from COVID. Still 3 years after the fact, all the jobs that we're adding, everything that's going on is really the bounce back from COVID. So I wouldn't say the economy is fabulous or great or whatever. To me, it's
so
still
we're just
a bounce
back at where the trend line would have been. Yeah. But to that point, and considering what it took to get here, $6.7 trillion, don't pay these bills, don't pay those bills. Now that all of that's coming back, will we ever get through that trend line, or do you think maybe we'll start to falter again?
Well, I think we're going to have a problem going into the second half of 2023. Everyone's so bullish, bullish, bullish. We started out the year up. I was surprised by that because remember, 2022, we fell off a lot. So I've been really shocked at how bullish the market has been this year, but it may not last. People are saying we're in a recession. We started a recession. We're out of a recession. We're going into recession in 2024. The fact is that, overall, when you look at the economy, if we have such low unemployment, Powell is not going to cut rates. And people are betting the farm that he's going to cut rates in early 2024. And if he doesn't, and we keep getting this boost up higher in rates, that is going to hit the economy. Because remember, businesses borrow money, and that's going to affect it. And of course, people borrow money too, and it's going to affect their spending.
David, to that point, the recession was the call coming into the year. Right. And now it's shifted to, potentially a soft landing. If Powell doesn't blow it, and who's to say he hasn't already, right? Put so many rate hikes into the system. But the sense is maybe we could have one of these elusive soft landings. You buying that?
Goldilocks sounds like a great story to read my kids, but I don't think that's a really good indicator of what the economy is doing right now. This is a very interesting moment. When we just heard last week about PCE going up 0.2, I think that's a really important moment for us to just be checking in on the fact that, hey, we're seeing inflation come back up right now. We're looking at credit card debt in the consumer hitting over $1 trillion this last month. Oh my goodness, is that a big deal? But as we just start out September, October here, notoriously the two worst months of the year in any year, and I think that we're probably going to see a lot of things just begin to unravel.
So you're looking for what they're calling like an echo boom. The inflation booms, to your point, at 9%, it comes down, but you're saying another boom back up.
Yeah, exactly. I think that we are tracking in that direction. In fact, it's very inflationary to be spending money the way that we are. And of course, Janet Yellen just shared with us $2 trillion more here to spend for the second half of the year. Yeah. So I'm certainly very concerned about that, given the fact that inflation, according to Milton Friedman, is literally the way through printing.
What's interesting about that as well, Melissa, now, if the Federal Reserve says they're going to let their bonds roll off the balance sheet, they're not buying. Japan, they're the biggest holder of our treasuries, but they're buying their own treasuries these days. China's been selling our treasuries like crazy to keep their economy going. Who even buys this? Isn't that a reason for bond yields to go up?
Well, you're thinking logically. The problem is we're in a situation which is an anomaly. Part of it is the big spending and all the stimulus spending from COVID, like you just said. But remember, think back. People keep saying, oh, remember when rates were 11% for mortgages? We had worse than this. It was higher than this. That may be true, but like my parents, my grandparents, they didn't spend more than they had. People nowadays overspend. We're using credit now like we never used credit 30, 40, 50 years ago. So when you have credit card rates at 30-some% and you have mortgages at 7.5%, yeah, people have had an uptick in what they're making in wages, but it doesn't account for all the high cost of things and then what people are paying to borrow. So, you're trying to think logically based on the past, but we're in a different type of environment right now. And I think there's still banks that could possibly go under, small regional banks, and the big banks are going to buy them up. And that's part of it is the bond problem because they're invested in these long-term bonds. And if rates keep going up, it's going to hit some of the smaller banks.
Yeah, you mentioned, I saw what Macy's reported. I didn't even realize the Macy's card is 34%. It's mind-boggling. I know the average
I love Macy's, though.
Listen, when you get it right, you come in and it's Christmas time and they say, hey, what? Don't put that on the regular Visa. Use this one and we'll give you an extra shot. Stryzewski. Then you pay for it the rest of your life. So under these dire circumstances, these clouds, you guys are bringing in these dark clouds. Supposed to be a upbeat
I know,
day.
we're sorry.
David, what happens then to markets then? Where do you put money?
I mean, I have a big concern right now about the bond market in general. There's 5 ways that bonds lose money. And so one of those that you might even have been alluding to there is if interest rates go higher on those bonds. Of course, that's the seesaw effect that we saw. And that's a big challenge that banks have today. You know, they were told inflation was transitory, so they locked in these, really long dated bonds at 3% mortgages for all of us. Those are their assets. That's way below trend right now. So it just seems to me like the market is this FOMO moment. And if you look at Shiller indexes, it's overvalued by 54%. Buffett index, by the way, if we get into a recession, it's going to even be worse.
Yeah, who would have thought? Done in by YOLO and FOMO. Thank you both very, very much. Really appreciate it. All right, folks.